Hello everyone and welcome to this very exciting session on financial management. Uh, in this session I wanted to discuss November 2017 question 1. November 2017 question 1, which is Chap Chap Uganda Limited. Of course, I believe by the mere fact that you're running this lecture video, you have already read through the question and you know the details of the question. But I will briefly take you through quickly. Of course, we are given Chap Chap Uganda Limited, which is a company dealing in electronics in Kampala. The company is considering expanding its operations beyond the boundaries, of course, that is of Uganda, to take advantage of the East African Community Common Market Protocol, where goods, services, and workers can move freely without any hindrance. So the examiner comes along in that way, giving us a lot of information here. They've given us the current capital structure of the company, which is going to be the case. The examiner will indicate what the company is deploying in terms of finances. And as you can see in this case, we have the ordinary share capital, we have the reserves, we have 15% debentures, and 7% preference shares. The total capital structure is 3.3 billion. And in the additional information, and as it will always be done, they will give you the prices and the market values and all that information. What is very important here is note number 5, where they're telling us that the company is looking for 1 billion, and this 1 billion is meant to facilitate the expansion of the business's operations, and this is going to be raised in the proportions of 70 to 30 in market values. Please note this, 70 to 30 in market values. So it will mean that if I apply 70, the 70 is going to be definitely 700 million, because if it is 70% of 1 billion, then that means that is 700 million. So 700 million is going to be raised through ordinary share issue, and then the balance of 300 million is going to be raised through issue of debentures. And of course, as we discussed in the lecture, we mentioned that if you have additional capital raised, there's going to be an implication on the current selling price of your ordinary shares, because of several perceptions by the ordinary shareholders. So they're giving us the changes here. The selling price will rise from 1,500 to 2,000, maybe because of the future prospects of the company resulting out of the expansion. We are also told that the dividend is going to be, of course, for you to entice the shareholders, the dividend is going to be raised to 250 per share from 200 million. The expected growth, I can see it is remaining at 5% as in the initial arrangement. The 5% new debentures will be issued at a price of 90, and this debt is irredeemable. So the gist of our discussion is around here on part A, where we are required in Roman 1 to determine the weighted average cost of capital of the existing funds. So we shall begin by determining the WACC and then proceed to calculate the marginal cost of capital. So this first lecture video is covering Roman 1, the weighted average cost of capital. Then you'll have to go to the next lecture video, which calculates the marginal weighted average cost of capital. So in the working, I know you've done the working, and of course this lecture video is meant for those who have tried it out, not for those people that have not challenged themselves. So if you have not yet done it, try to do it so that you can follow through and see whether you have got it right. It is always good if you challenge yourselves always. So as we discussed in our lecture, we said that step number 1, you determine the specific costs of capital. The specific costs of capital are in line with the existing capital structure. So it means that you're going to look for the ordinary share capital, cost of capital. You have to look for KE, you're going to look for the cost of equity, which is KE, that is for the ordinary shares, and then you look for KD for the debentures, then you look for the KP for the preference shares. So the cost of equity, this is the formula from the dividend valuation model, DO1 plus G over PO plus G. So initially the dividend, the current dividend is 200 million, the growth rate is 5%, and the price of our ordinary shares is 1,500. This one I'm picking it from here. Additional information number 1. They are saying that the ordinary share capital is currently selling at 1,500. So if you simplify this, you should have come to KE of 19%. So after you have handled KE, then you look for KD. This is going to be in respect to the redeemable bonds or debentures for that matter, because they're telling us that the 15% debentures are redeemable after 10 years. So the KD is for the redeemable debentures. Okay, this is all debt, so you can always change this to debentures, no problem. So you remember we said that if the debentures are redeemable, then the cost of debt is going to be the internal rate of return, and it will mean that you need to calculate NPV twice. You need a positive NPV and negative NPV. The best starting point is to use the coupon rate, which is 15%. So when I used 15%, I came up with negative NPV, which became my NPVB. And of course, for you to get a positive NPV, you must lower the rate. So I lowered the rate to 10%, which most of you did, those who submitted the work. And I definitely got a positive NPV, but you could also lower it up to 12%. I think it could also give you a positive NPV like most people did. So NPVA comes to 30.7, and then this working number 1 is meant for the interest, which is part of the cash flow. For those who have not seen this, what we do, we look at the initial investment, which is the purchase of the debentures or bonds for that matter. And for you to purchase the debentures, you need to invest in 100. We are told that when you look at the question, we are told that the debentures are selling at par. When they say that the debentures are selling at par, it means that the selling price is the 100. You know, I told you that bonds, debentures, the face value or nominal value is 100. So after investing in the debt instrument, you now receive interest over the 10 years. They keep on paying you interest in the 10 years. But what is the interest? The interest is the coupon rate times the face value. The coupon rate is 15%, the face value is 100. So that one gives you 15. And then in the final year, in year number 10, you get the par value, which is the 100. So the 5.019, the 0.245, you must pick it from the tables. The 5.019 is the annuity, 15%, 10 years. Then the discounting factor in year 10 at 15% is 0.247. Check the tables and you verify this. So that gives us the present value as these are the figures. And then when I lower the discount factor 10%, this is the annuity and this is the discounting factor in year number 10. These are the present values that I get. Verify these. Okay, you verify this. You can even pause the video and look at the figures and then you continue. So after of course getting my NPV, after getting my NPVA and my NPVB, I now substitute in the internal rate of return formula, because the KD is the internal rate of return. This is the formula which you have already looked at in my previous lecture videos or in the previous live interactive sessions we've had. So when you come down here, you see that I've substituted the 10% in the place of A. I've substituted the 30.78, the positive NPVA. Then of course I subtract NPVP, which is a negative, but remember there's some math here. You need to be careful. I would say that some people got challenged here. This negative and a negative gives you a positive, so please look at this, and then leave this one in percentage, 15% minus 10%, and at the end of the day you see that you still get the cost of debt as the coupon rate, 15%. So after getting your KD, you now move to KP, which is the cost of preference shares, and we say that for you to get the KP you get D over PO. So that's going to be 7% times the face value. When you look at the question, our preference shares have a nominal value. Okay, they have a nominal value of 500 shillings. So for you to get the dividend is calculated on the nominal value. That's going to be 7% times the 500. Okay, 7% times the 500. So when you come back here, you see that I've substituted the 7% times 500 to get the D, that is the dividend. Okay, 7 times the 500, I get the dividend. Then we are also told in the question, when you look at our question here, we are told that the preference shares are selling at 550. So you have to substitute and bring your 550 in the place of the price PO, and that gave me 6.36%. So that leaves us with now the market values, because now we are done with the KE, KD and KP. So you can still pause this, take the figures. If you didn't get the figures right, you can pause this and take the figures. Then you proceed to the market values. Now the market values, we need the market value for equity, VE, the market value for debt, VD, and the market value for the preference shares, which is VP. Now of course I mentioned that the market value is going to be the number of shares times the price, the market price. So for you to get the number of shares, you have to get the total ordinary share capital divided by the nominal value, which is this. The total ordinary share capital is 2 billion divided by the nominal value, which is 1000. That gives you the number of ordinary shares in the 2 billion. So since the ordinary shares are selling at 1500 in the market, you multiply the number of ordinary shares times the price, which is this one here. So that one gave me 3 billion. Okay, that one gave me 3 billion. You do the same for the debentures. You look for the number of debentures times the value, but of course for the debentures it is quite easy, because they are selling at par. The 100 cancels out to the 100 and you remain with 1 billion. For the preference shares, you have to look for the number of preference shares and multiply with the price in the market. So to get the number of preference shares, you have to look at the total capital in terms of preference shares, which is this 200 million divided by 500. So you multiply with the price in the market, which is 550, to give you the market value, VP. Okay, so I ended up with a figure of 220. I end up with a figure of 220. I end up with a figure of 220 here, and then I proceeded to compute the total market value, which is the 3 billion plus 1 billion plus 220 million, giving me the total market value of 4.2 billion. So still here you can take you can just pause the video and put down these figures for those who did not get this correct, and then you proceed. Alright, so finally the last step is to calculate the weighted average cost of capital. So this is the vertical format that I encourage you to use. So you show the source ordinary share capital, the percentage cost, and the market value. So the ordinary shares, that is 19 times 3 billion, gives us 570. The debentures, that's 15% times 1 billion, giving me 150. Preference shares, that is 6.36 times 220, giving me 13.9. So this is the total market value, and this is the total percentage cost times the market value, the product. So you just put the 733 over the 4.2 billion times 100, and that should be giving you 17%. So our work comes to 17%. Again, look at this, verify the figures, but you should be getting to 17%. So I am sharing this first, and then I'm going to share the next lecture video, which covers the marginal cost of capital. For you to be able to get the correct marginal cost of capital, you should have calculated the weighted average cost of capital correctly. So this is not an area you should joke around with, because most of the marks, if this area is set, it will have huge marks. When you look at the question, the weighted average cost of capital was carrying 15 marks. So these are very good marks. So please try to practice on this as much as you can. So the next part goes into marginal cost of capital. So I want you to go straight to the next lecture video and pick up my working and discussion or explanation on marginal cost of capital. Thank you.